Welcome, everyone. I am thrilled to guide you through the strategic powerhouse of modern business, corporate treasury. Let's get started. Welcome, everyone. Imagine being the lifeblood of a massive global organization. That is exactly what the corporate treasury is. At its core, treasury management is about handling banking requirements, funding the business, and mitigating financial risks. Why is this so vital? Because in any business, there is a fundamental timing mismatch between when you pay suppliers and when you collect from customers. Our job in Treasury is to ensure the company has cash at the right time, in the right place, and in the right currency to meet its obligations. We do this through rigorous cash flow forecasting, strategic bank relationship management, and robust Treasury policies. It is not just about counting money, it is about safeguarding the company's survival and growth. Let's look at this diagram. It illustrates the core function of Treasury. We start at the top with business operations, which inherently create a timing gap between money going out and money coming in. Treasury management sits right in the middle, acting as the critical bridge. From there, it branches into our three main pillars: liquidity management to ensure we can pay the bills, risk management to protect against currency and interest rate fluctuations, and funding to fuel future growth. Historically, Treasury was often seen as a mechanical, back-office payment processing unit. But today, it has evolved into a cerebral cockpit. Why the shift? Globalization, volatile financial markets, and post-crisis regulatory changes have made capital management incredibly complex. The business doesn't just need us to process wires, they need us to advise the CFO on M&A integrations, optimize the global capital structure, and spearhead digital transformation. We have moved from a transactional treasury that merely executes to a strategic treasury that actively engages in corporate decision-making and predictive intelligence. We are now orchestrators of enterprise value, turning potential risks into competitive advantages. This timeline shows the evolutionary path of corporate treasury. On the far left, we have the old transactional model, purely focused on execution. Moving right, treasuries became process-efficient, standardizing controls. Then, they became value-enhancing, maximizing financial flexibility. Finally, on the far right, highlighted in pink, is today's pinnacle, the strategic advisor. In this phase, Treasury sits at the boardroom table, influencing M&A and global expansion. Now that we understand our strategic role, let's break down the how. Global Treasury operates on three main pillars. First is transactions and cash management. This is the day-to-day movement of money, maintaining bank accounts, and ensuring operational cash flows. The second pillar is balance sheet and liquidity. This means managing working capital, ensuring we have access to short-term commercial paper or long-term bonds, and maintaining optimal debt-to-equity ratios. The third and often most complex pillar is risk management. When you operate globally, you're exposed to massive foreign exchange, interest rate, and commodity volatility. We use financial derivatives like forward contracts and swaps to lock in prices and protect our profit margins. Here is a visual breakdown of our operational pillars. From the central Treasury operations node, we branch out to cash management, liquidity and balance sheet, and risk management. Notice how each maps to a specific outcome. Cash management handles daily flows. Liquidity ensures we have the funding and working capital to survive. Risk management tackles our exposure to FX, interest rates, and commodities. These three pillars must work in perfect harmony. As corporations expand into dozens of countries, managing these pillars locally becomes a nightmare. This brings us to operating model design. In the past, companies used a decentralized model. Each country managed its own banks and cash. Today, the best practice is centralization. Why? Centralizing into a global or regional treasury center gives us massive economies of scale, total visibility over our global cash, and the ability to offset or net our FX exposures. A deep dive into this is the in-house bank model. Instead of a subsidiary in France going to a local bank for a loan or an FX trade, they go to the central treasury. The central treasury acts as their bank, drastically reducing external banking fees and keeping liquidity within the corporate family. This diagram clearly contrasts the two models. On the left, the decentralized approach shows individual subsidiaries dealing directly with different local banks. It is fragmented and costly. On the right, the in-house bank model routes all subsidiary requests through a single central treasury entity, which then interacts with a global bank. This consolidated approach gives the parent company ultimate control and negotiating power. So, where do you put this centralized in-house bank? You establish a global or regional corporate treasury center, or GRCTC. Choosing the location is a massive strategic decision. Why? Because you need a jurisdiction that offers a highly favorable tax regime, free capital convertibility, and a deep pool of financial talent. For instance, cities like Singapore, London, and increasingly India's Gift City are prime hubs. Gift City, for example, offers exceptional tax exemptions and no withholding tax on interest paid to non-residents. When setting up a GRCTC, treasurers must rigorously evaluate these regulatory, tax, and infrastructure benefits to maximize the financial efficiency of their global operations. Look at how the regional treasury center sits at the heart of this network. The global parent company injects capital or policy direction into the GRCTC. The GRCTC then efficiently pools funds and distributes liquidity to the various regional subsidiaries like our Asian and European subs while acting as the single point of contact with external global capital markets. It is an incredibly efficient hub-and-spoke architecture. To execute these global strategies, you need world-class technology. Shockingly, many global treasuries still run on spreadsheets. Modern treasury requires a composable, API-first architecture. We are moving to cloud-native treasury management systems that connect directly to banking portals and ERPs. To give you a technical glimpse, modern treasuries use standardized XML formats like the ISO 20022 Pain.001 message. This acts as our sample code, a digital payload that triggers straight-through processing of payments via API, entirely eliminating manual data entry. Furthermore, AI is no longer just a buzzword. It is being actively deployed for predictive cash flow forecasting, anomaly detection in payments, and automated FX exposure tracking. This flowchart demystifies the modern treasury tech stack. Your company's ERP feeds data seamlessly via API into the cloud TMS. The TMS then pushes this data into an AI forecasting engine to generate predictive liquidity models. Simultaneously, the TMS communicates flawlessly with your global bank using standardized ISO 20022 XML messages. It is a continuous, automated loop of data and money. Let's look at a real-time, high-stakes use case, mergers and acquisitions. When a global corporation acquires another, Treasury is the critical player that ensures the deal actually settles. Imagine acquiring a multi-billion-dollar target. On day one, Treasury must ensure the settlement funds are pooled in an escrow account, leveraging syndicated loans or commercial paper. Post-deal, the real work begins. The target company might have hundreds of fragmented bank accounts and trapped cash in restricted countries. Treasury must immediately step in to rationalize these accounts, sweep the excess liquidity into our regional treasury center, and restructure the debt, perhaps issuing convertible bonds to manage the maturity profile. If Treasury fails here, the company faces a massive liquidity crunch. This Gantt chart outlines Treasury's critical M&A lifecycle. During the pre-deal phase, we secure the necessary fundraising. On settlement day, it is a precise, high-stress window to transfer funds to the paying agent. But notice the post-deal section, gaining immediate cash visibility of the acquired entity and rationalizing their bank accounts takes up the bulk of our integration timeline. It is a highly orchestrated operation. As we look toward the 2030 vision, Treasury is transforming into a predictive, digitally native control tower. The treasurer of the future isn't just a finance expert, they must be fluent in data science, prompt engineering, and API architectures. We will see the rise of real-time liquidity forecasting, ESG-linked capital strategies, and central bank digital currency integrations. The role of Treasury has never been more dynamic, challenging, or critical to enterprise success. Thank you for joining this masterclass. I invite learners to like, subscribe, and visit quicktechie.com for premium certification prep, including Q&A banks, full ebooks, audiobooks, full-length training, and interview guides. This final diagram illustrates our 2030 vision. The Treasury of the future rests on three foundational pillars. First, people, requiring hybrid skills in both finance and tech. Second, platform, leveraging APIs and cloud-native ecosystems. Third, predictive capabilities, utilizing AI to generate foresight rather than just hindsight. By mastering all three, you become an unstoppable force in corporate finance.